You may be curious about what an automated market maker is. Well, an automated market maker lets traders buy and sell certain coins by using an algorithm that figures out how much something should cost based on how much of it there is. When someone buys an asset, there are less of them, so the price goes up. When they give it another asset, the price goes down because there are more of them. Basically, it is the same as supply and demand, but an algorithm is used instead of a person. Welcome to Crypto Coach, where we break down things about cryptocurrency so you can understand them. We'll explain what an automated market maker is and how it works in this video. Let's say you're a potato farmer. You're sick and tired of going to work and seeing potatoes everywhere, then coming home and eating more potatoes. Even though you can cook some potatoes in very interesting ways, you don't want any more potatoes. But here's the real kicker. You live in a village of potato farmers, so you can't really trade your potatoes for anything else. You think it would be great if I could trade my potatoes for something else, like apples. Well, a trader with a boat shows up and says, I found a village to the east that grows apples, but they're sick of them. I'm here to see if you want to invest in a trade. Your wish has come true, so rather than let this opportunity slip away, you tell the trader that you agree to join the trader in exchanging apples and potatoes. The apple farmers have put up 50,000 apples, and the trader says that if you provide me with 50,000 potatoes, we can begin. Your village holds a meeting to discuss whether or not they want to join the trader in this exchange. He says, but here's the thing. I have a magical genie with me who will store all 50,000 apples and 50,000 potatoes in his magical lamp so they don't go bad. But he wants to maintain a perfect ratio of the value of both of this, the trader says. Since we put together 50,000 apples and 50,000 potatoes, he wants both of these numbers to always multiply to equal 2.5 billion, which is equal to 50,000 times 50,000. This way, if there are less apples in 1 year, the apples will be more expensive to buy. Now, if you're still not sure what the magical genie said, it was the formula for a type of automated market maker called a constant product automated market maker. It uses the inverse formula that x times y equals k. Well, x and y are the amounts or quantities of the things you have, and k is a constant, which means it doesn't change. In this case, k is 2.5 billion. So let's keep going with an example so you can maybe get a better idea. The trader says that there are exactly 50 apples and 50 potatoes right now, but that's because I've set the price of each at $1 when you start trading. One of this could get more valuable, so it should cost more than $1. Let me give you a real-world example so you can see how it works. Okay, so right now there are 50,000 apples and 50,000 potatoes, and when you multiply them together, they must add up to 2.5 billion. Suppose a potato farmer has 7,000 potatoes to trade for apples. So he hands them over and waits for the genie to figure out how many apples to give him. Now we have 57,000 potatoes in the genie's lamp, but we need to know how many apples to give the potato farmer, so we divide 2.5 billion by 57,000. You might be wondering why. The answer to this math question is 43,859. So this is how many apples should be left in the genie's magical lamp. But there are now 50,000. All we need to do is find the difference and give it to the potato farmer. Well, the difference is 6,140. So we give the potato farmer 6,140 apples. You might be wondering why we gave away 7,000 potatoes but only got about 6,000 apples back. Well, as more and more people bought apples, their prices went up. The farmer didn't get back exactly 7,000 apples because of this. So now the genie's lamp has 57,000 potatoes and 43,859 apples. Let's make sure that we didn't upset the genie. The magical genie is still happy because 57,000 times 43,859 is equal to 2.5 billion. If you've made it this far into my description of how an automated market maker works without using a single technical term, then I think we both deserve a big thumbs up for our effort. However, before we go on to the next example, let's have a look at how much each asset costs in dollars. So let's imagine that there were $50,000 worth of apples at the beginning. Because the genie promised to sell them at $1 each, and because there were 50,000 of them, we may simply keep the number at 50,000. This is the amount that each asset should equal when valuing them. The price per potato would be 87.7 cents if we had 50,000 potatoes over 57,000, which is the number of potatoes we have available. As for why they dropped from $1, it's because someone brought the genie significantly more of them. Basically, it's supply and demand at work. If you could grow gold on trees in your backyard, for example, gold would become a lot cheaper because there would be a lot more of it. The more there is in the genie's lamp, the cheaper they will be. So I'm going to stop calling it a genie's lamp and call it what it really is, a liquidity pool. So let's figure out how much the apple costs. The calculation would be 50,000 over $43,859. This means that the apples are worth $1.14 total. The price went up because there were fewer in the liquidity pool. So since this potato trader put a bunch of potatoes into the liquidity pool and took a bunch of apples out, the price of apples went up and the price of potatoes went down. Supply and demand, which is shown in the formula X times Y equals K, is the main reason. So let's look at another example. Say, a potato farmer grows 10,000 more potatoes, so there are now 67,000 potatoes in the pool. We need to know how many apples to give that farmer who grows potatoes, so we divide our constant, which is 2.5 billion, by 67,000 and get 37,313. This means there should be 37,313 apples in the pool, but we have 43,859 right now. So we just figure out the difference, which is 6,546, and give it to the potato farmer. This time, the farmer who grew potatoes paid even more for apples. He kept buying them, so the liquidity pool kept raising the price. That way, it will never run out. As he buys more, the price will keep going up by a lot. So there are now 67,000 potatoes and 37,313 apples in our liquidity pool. Both of these numbers add up to 2.5 billion, which makes the genie, which is really an algorithm, happy. In order to get an idea of how much it will cost, divide $50,000 by 67,000 potatoes, meaning that the potatoes are now worth 74.66 cents, which is significantly less than they were before. On to the next problem. Take $50,000 and divide it by 37,313 apples. Because the apples have risen in value, they are now worth $1.34. So once again, we saw that the price of potatoes decreased while the price of apples increased. If you have been following along, you've probably figured out how an automated market maker drives up the price of goods as more and more people buy it. As a result of the decreased supply and the algorithm's preference for 50/50 pricing, apples are now more expensive. So, if you multiply the price of each asset by the total number of assets in the liquidity pool, you would still get $50,000 worth of apples and $50,000 worth of potatoes. How about doing another one example really fast just to nail it down? This time, a farmer with 2,000 apples comes along and adds them to the liquidity pool. There are now 39,313 apples in the pool, but we have to figure out how many potatoes to give him. So, to finish the math, we divide 2.5 billion by 39,313 and get 63,592, which is the number of potatoes that should be in the pool. Well, there are still 67,000 potatoes, but the pool only needs 63,592. So, we give the apple farmer the difference, which is 3,488 potatoes. So in the end, the farmer gave away 2,000 apples and got 3,488 potatoes because his apples were very valuable at the time. You should be aware that a real liquidity pool can contain assets totaling millions of dollars, and that the more money in a liquidity pool, the more stable the pricing will be. This gap in prices wouldn't shift as much as we saw in our example because you were only exchanging a very small proportion of the total number of Apple shares in the pool, even if there were 1 million Apple shares and 1 million potato shares. When it comes to liquidity pools, you should also realize that the people who put money into them get rewarded for their efforts. Investors get a small percentage of each trade that occurs on the platform they own. In the long run, even if each trade may only account for less than 1% of an investor's total portfolio turnover, this can still be a profitable investment strategy. Also, keep in mind that liquidity pools can quickly become overly complicated, especially if a new trader wants to add another 50,000 apples and 50,000 potatoes from the new villages he discovered. The question is, how do we ensure that investors can get their money back as the price fluctuates? Consider the possibility of finding and including a pineapple grower in the trading pool. We at Crypto Coach try to make this video short and easy to understand. So, if you want to learn more, consider subscribing to watch our future videos or looking at the playlist in the description for similar topics. We really appreciate you watching and we hope you learned something. See you in the next video!